Endowus. We have a really exciting and fun webinar tonight. Very common topic, active versus passive investing. But we have a special guest, and we'll be talking about really interesting and fun facts about active and passive investing that maybe you might not have heard elsewhere. So first of all, I want to start off by introducing our guest, Ser Jing. Ser Jing, say hi.
Hi everyone, glad to be here.
All right, thanks for joining us today. Really
No,
excited.
thanks for inviting me.
Yeah, really. Okay, sorry, I got a multiple sound. Okay, so we're gonna kick off first with some disclaimers, and then our usual plug for our Endowus Live YouTube channel. Thank you so much for following us, content. We work really hard as a team to provide good differentiated content for financial education and improving literacy for all people, but especially to our clients at Endowus. And we really enjoy having guest speakers like Ser Jing, who really enrich our discussions and our thought process and add to the value of these webinars. So please click and subscribe below so that you receive an automated connection, so that anything new that comes up or is interesting, you'll receive it straight away. And a lot of the old videos, we recently had some good ones with Dimensional Fund Manager and also PIMCO, for example, and guest speakers. So please go back to our YouTube channel to listen to that. And next week, just to plug for next week, we have another great guest speaker, Alvin Chow from Dr. Wealth. So Alvin is the CEO of Dr. Wealth, a pretty well-known firm, does a lot also for financial education, but another active investor, by the way. So that's really going to be fun. So please join us next week. So Ser Jing, I'm going to hand off to you so you can introduce yourself in a bit more detail. And as an active investor, maybe share some credentials and thoughts about what you've been up to since leaving Motley Fool, and your experience with the Good Investor blog, which is a fantastic blog, by the way. Really love the pieces that you and Jeremy write. So thank you so much for sharing all that great content. But over to you, Ser Jing, to get us going.
Sure, thanks, Sam. And yeah, just first off, thank you everyone for tuning in today. It's really my honor and pleasure to be here. And yeah, thank you, Sam. Thank you everyone from the Endowus team for extending this invite. I've been so excited over the past week or so. Waiting for today to happen. Because I know that there will be a lot of great discussions that's going to happen, and yeah, I'm just really excited. So just a quick kind of introduction to myself. I have been investing for more than nearly 10 years now. I started learning about investing when I was about 17 or 18. I kind of really got started because I was in junior college doing economics as one of my subjects. And I thought that, the whole idea, most of the underlying assumptions that I was being taught, I thought that they were wrong. And so I wanted to kind of really look for people who worked with money. And so I kind of discovered people like Warren Buffett and his peers and his mentors. And that was how I really kind of got started with regards to investing. That was because everything that these people shared, it kind of really resonated with me. Shortly after I graduated from university in 2012, I got a call from the Motley Fool saying that, we are going to start launching the Motley Fool in Singapore. Would you like to join us? And I was very happy and eager. I was like, yes, let's do this. And so I've basically been with the Motley Fool Singapore since the very beginning. In October 2019, the company kind of had to shut down because of commercial reasons from the US, and because of that, I had to leave the company. But during my tenure, I think one of the proudest things that I did was, I was one of the co-leaders of the investing team at the Motley Fool Singapore. We were licensed by the MAS to give investment advice through digital means. And so what we did was we would give stock recommendations every month. And our flagship product was launched in May 2016. So from May 2016 to October 2019, that was the time where I was basically helping to co-lead the investment team and to pick the investment ideas and to maintain the investment ideas and so on. And what we did in our flagship newsletter, Stock Advisor Gold, was that we would give 2 recommendations a month, one from the Singapore market and one from the international markets. So like we were looking at stocks all over the world, the US, the UK, Malaysia, Hong Kong. So what we did was we picked 2 stocks a month and we tracked our returns by taking the simple average of the return of every single recommendation we make. And at the same time, we also track the return of a global stock market index. So it's kind of akin to like the MSCI World Index. So we track our returns against that. And one of my proudest achievements with the company was that we managed to nearly double the global stock market's return during my near 3.5 years helping to run the service. So that is like my track record in terms of that's my professional track record in terms of being an active investor. We at the Motley Fool Singapore, we were very much business focused investors. We do not pay much attention to what's going on in the macroeconomy environment. We think it's important, but we think it's also unknowable, and so we always prefer to focus on things that are important and knowable. And to us, things that are important and knowable would be like company fundamentals. So we spend a lot of time understanding businesses, understanding management teams, and trying to find really good companies that can grow at high rates over the long run. So that was what we kind of really did. And
just a quick question on this.
Yeah,
so
sure.
you only did pure bottom-up stock picking, so there was no macro or thematic involved?
No, so like it was really just pure bottoms up stock picking. We will go through company by company and we will find like the favorite ideas that we have at that particular point in time. Now, there are perhaps certain sectors that we're interested in, but I think we developed an interest in those sectors not because we thought that the sectors were interesting, but because in our search for investment opportunities, we realized that these particular sectors looked really interesting. So it was kind of like the company's commentary that led us to the idea that there are certain sectors that look really interesting and that perhaps we should spend more time digging into those particular sectors.
Okay, sounds good.
Mm-hmm.
And then
maybe we can move on to the next slide. Yeah. So I mentioned earlier that I've been investing for nearly 10 years for my family. So I started investing for them in October 2010 in the US stock market. And so I've been doing this for nearly 10 years now. The portfolio is in the process of being liquidated for a project that because I'm in the process of setting up my own investment fund. So we are liquidating most of that portfolio to be so that the capital can be transferred to the fund. So this investing journey is also something that I'm quite proud of and that I'm happy that I have had the opportunity to do so. So over the past near 10 years, my family's portfolio delivered a 19.5% annualized return in the US stock market without including dividends. And this compares against a 12.7% annualized return for the S&P 500, including dividends. So I've been just like in the Motley Fool, investing for my family. It's bottoms up. I find individual companies to invest in. I do not make any macro calls. I do not do any kind of like thematic selections. It's really just company by company from the bottoms up. And we have been super patient investors. I started in October 2010 by investing in 6 stocks for the portfolio. And by the time it was in 31st of May 2020, the last date that I tracked its performance, we had about 54 or 55 companies in the portfolio. And we have only made 2 sales that were voluntary in nature. And so, yeah, we have been very long-term investors. And I often use my family's portfolio performance as kind of an example that, this very patient, business-focused, long-term investing can still really can really work. So you can see that the portfolio has some volatility, the blue line, but by and large, just by patiently holding on, I think we have done pretty well. Yeah.
So Ser Jing,
yeah.
For those who don't know, Ser Jing wrote an article as he started liquidating his family portfolio.
Oh, yeah.
It's a great article. I really liked it a lot.
Thank you.
Really well thought out and really expressed your philosophy very well.
Thank you.
So I would encourage everybody who's listening to check it out at the Good Investors blog. But did you start off with the
Mhm.
intention of buying and holding these stocks, or is it something that as you went by, you kept on holding on to the winners or adding to the winners? Is that something
Mhm.
that developed over time, or is it something that you started from the get-go? I was curious about that.
Yeah, yeah. So the whole idea of wanting to be a long-term investor actually started from the very beginning. What the very first investment book that I read in my life was Common Stocks and Uncommon Profits by Philip Fisher.
Yeah.
That kind of laid the groundwork in terms of how I would think about the markets. And because a lot of the things that he said made a lot of sense. But of course, over time, I developed my own investment philosophy that's different from Philip Fisher. But I think the general guiding principles, of looking at stocks as a piece of a business, of thinking long term, this was always with me from the very beginning. And they were also lessons that were kind of like often talked about at the Motley Fool, which
Mm.
before I became an employee of the company, I was actually a customer. I subscribed to one of the Motley Fool US newsletters in July 2010. Yeah, shortly before I started investing. And yeah, so I learned a lot from there as well. Like, the whole idea of like how long-term investing actually works, and looking at like the track record of the investors in the Motley Fool, especially one of the Motley Fool's co-founders, David Gardner. I think that it's very clear that if you can find the right companies and if you can hold on to them for the long run, you can do really well. But yeah, I started off from the get go wanting to be a really long term investor. So I mentioned I bought 6 stocks in 2010. I still hold on to 4 of them. The two that I sold were the voluntary sales that I mentioned, and the reason why I sold them is because I believe in this idea of managing the portfolio. So this idea is that we should be making our portfolio reflect the best vision that we have for our future. This is something that David Gardner once said, and it's something that I find to be very meaningful and that I believe in. And so the 2 companies that I kind of sold voluntarily were 2 companies that were in the oil and gas industry. So Atwood Oceanics and National Oilwell Varco. So I sold them in 2016 and 2017 respectively. And yeah, because I know for me, I think the best vision that I have for the world's future is one where our environment is powered by clean energy, renewable energy that does not pollute and destroy our environment. And so I did not really want to have anything more to do with the oil and gas industry. And that was why I decided to make a very rare decision to sell voluntarily.
That's great.
Yep.
Shall we move on to the next slide?
Yeah, let's do that.
So what are you
Here.
doing to these days? And Jeremy actually wrote on the YouTube chat. So hi, Jeremy. I was
Oh,
just
that's
posting
great.
that.
Yeah.
He's going to share the link that I mentioned. But it'll be
Oh,
good.
beautiful.
Yeah. So you have the link here, thegoodinvestors.sg. So anybody who can see that, just go to that blog and you can see the articles. Yeah.
Yep. Thank you. Thank
So
you. Yeah.
yeah,
So
give an
so
update and shout out to Jeremy.
yeah. So since leaving the Motley Fool Singapore, so Jeremy Chia is a good friend of mine. We've known each other since we were 17. We are currently 33, so nearly half our lives. Uh, we were both working in the Motley Fool, and then after the company closed, we left, and we decided to set up our own investment fund, which is the compounder fund here. That's shown in the slide. And we also started our own personal investing blog called thegoodinvestors.sg. And the reason why we wanted to have 2 kind of entities here is because we believe deeply in investor education, and we think that the good investors can be a really good avenue for us to share about our investing thoughts about what's going on in the market in that sometimes may not necessarily be related to an investment fund. And so we wanted to have a vehicle where we can share our thoughts, in a completely commercial free setting. Yeah. So the only commercial activity we are doing with regards to investing would be our investment fund, which is compounder fund. So we kind of set it up with the idea to accomplish 4 big things. First is that we want to provide a really good investment solution for our investors. We are it's going to be global in nature. We're investing in stock markets around the world, but with a very long-term business focused type of mindset. And then we want to charge fair fees that can benefit people. We want to have the fund be a platform for investor education. So we are going to be running it very transparently. And lastly, this is kind of like a personal thing for Jeremy and myself. Compounder fund is a business, so running a business gives us the potential to earn more than we can as an employee. But the idea of but being able to earn more means that we also have more financial resources that we can give back to society. So one of the things that we really want to do is that we have pledged to give at least 10% of our personal profits from running compounder fund every year to charities of our choice. And this is our way to, we see compounder fund as more than just a business, and it's our way to really kind of build an investment fund that can do more than just invest. We can help to benefit society as well. So yeah, this is what I have been busy with since leaving the Motley Fool in October 2019.
Yeah, sounds good. And really excited about your new journey. I think it's fantastic. I
Thank you.
really do encourage young investors to be entrepreneurial. I mean, it's great to go into big companies and, get fancy titles. But oftentimes, as an investor, you're constrained because you're joining an existing firm that has a very long track record or an existing structure or philosophy of investing. And sometimes people don't fit in. You're actually a value investor, but you're working for a growth investment firm. That's not a very pleasant experience. So I think it's really important to discover yourself as an investor. I really like that the fact that Ser Jing is an avid reader. He reads a lot of books. He mentioned the Uncommon Profits book
Yep.
by Philip Fisher, and a lot of good books out there. And that's a really old book, so a lot of young people may not know about it, but it's a classic, and it's a great book, and it really helps frame your mindset from a young age to how to invest properly. So I think it was really helpful. One of the things that as I was listening to you, I heard was what it reminded me of an article I wrote about Barton Biggs, and previous webinar about it. But he said he would always prefer being an owner of a business rather than a lender. And I think that's a really good way to think about how you invest, because you're really owning the company, right? So I think that is something that triggered a thought.
Yeah, that's thanks for sharing the Barton Biggs. I think I watched that webinar, but I may have missed out on that. But yeah, that's a really good way to think about it. Being an owner of a business rather than a lender. Yeah,
Hmm.
very
Sounds
beautiful.
good. So we'll keep moving in the interest of
Yep.
time. So I thought that I should maybe do a small plug about me, my career, because Ser Jing is so amazing and talented and achieved so much in such a short period of time. I've achieved much less in a longer period of time. I've been around for much longer, 26 years. I began in 94. I began in investment banking and the sell side, as it's commonly known, and then I moved over to the buy side in 2005. And I was there for over a decade. Most of it was with Morgan Stanley, 17 years with Morgan Stanley, 13 of which was on the asset management side. And I was a portfolio manager, and not many people know, and I don't really have an opportunity to talk about it a lot. But I was, as I said earlier, an active investor, picking stocks as well. I was pretty good at it, but with a decent track record. But as I shared with Ser Jing once, I had a long, good run, and then I crashed and burned as well after that long period. So it happens to the best of us. But one of the things that really etched deep in my memory is about how fundamentals will always have out. That is really about the fundamentals of the company. And when I began in the industry in '94, within 3 years, this is what I had to go through: the Asian financial crisis, and in U.S. dollar terms, Singapore was down 70%. This is MSCI Singapore, because I think STI wasn't really there at the time in its current form, at least. Korea was down 87, but Thailand and Indonesia was almost wiped out. In U.S. dollar terms, more than 90%. I mean, that's like going to zero. I mean, these countries went bankrupt effectively, right? If you think about it as a stock, it's so all of these markets have subsequently made it back, and have risen to historic highs, and have continued to give us decent returns. But I think it's important to have perspective that we are, the stock market is volatile. It is a cycle, but in the long term, the markets do win out, and it's the good companies that win out and drive the index and markets forward. So, as an institutional investor, which I was for the longest time, I was managing mostly institutional money from sovereign wealth funds, pension funds, and institutional money from insurance companies and stuff like that. And Ser Jing, you are beginning and embarking your journey on as an institutional investor proper. Um, And so, I think there is a bit of a halo behind institutional investors, and people think that they do it differently. But really, it boils down to, I think, the three P's of investing, which are the most important fundamentals, which is philosophy, performance, and people. But in the end, the investing business is really a people business. I think good people, who are good investors, are the ones that generate the performance over the long term. And so, I don't know, Serging, if you have you heard of the three Ps of investing, and any thoughts about this?
Yeah, no, I think I heard you mention this to me before a couple of times, and I really agree that ultimately it is the people, and I love the three piece concept. But I think what I would say is that I think oftentimes you mentioned earlier, you made a great point about how sometimes people just don't fit in certain firms because like you're
Yeah.
an investor, and so I think it's also really important for like the organization, or at least the leaders of an organization, to really set the tone about how they think about investing, because I think ultimately that then flows down. Like if you're a firm that is always trying to force your people to produce short-term performance, then no matter how good a philosophy that your people want to build, it's not going to be able to get done. Yeah, so I think it has to
Mhm.
start from the top, the
Yeah.
the leaders of the firm.
And that's, sometimes it's possible because, the leadership is able to be flexible about it. But
Yep.
sometimes, like certain firms just are set up as a value outfit, or as a growth outfit, or as a quant outfit. So it's defined by, the philosophy, and the right people need to find the
Mm.
right firm. But I think, like yourselves, if you can, start off embarking on your own journey, and this is how everybody started, right? Warren Buffett and, all the famous guys that we're going to show later all started from, the basement of their house, or, somewhere very small, and got to
Yep.
where they are. So, yeah. So really want to encourage you guys, and I want to encourage any young entrepreneurial investor to, go it, alone, and, or with a team, even better. You have Jeremy with you, which is great.
Yep.
Okay, so the other thing that I wanted to say was institutional investors aren't all better investors. They can be. Many of them, I've met really amazing investors in my lifetime. Bottom Bigs I've mentioned before, but other great guys. I won't mention their names; they'll be embarrassed. But really great investors. But I think institutional investors do have an uncommon advantage versus individual investors. And this goes to our active passive debate that we'll go into in a bit more detail. But it really boils down to three things: advice, getting great advice, from the top notch investment banks, access to great products that you wouldn't normally have, or access to investment, securities, or IPOs, certain advantages that always exist, as especially in fixed income. And then you have much lower costs because GIC doesn't pay upfront sales charges of 2%. They don't have to deal with trailer fees and stuff that individual investors have to deal with. But I think there is an aspect that is really important, which is that this is a professional job. It's a licensed industry by the MAS. Each investor has to be licensed as a representative, or as a fund manager. So it's a professional business. So there are professionals who do this better, and they get training, they have expertise. They manage their behavioral fallacies better. They have scale, they have efficient systems like trading platforms and technology. But in the end, it boils down to those uncommon advantages. And also, I think experience is really important. Ser Jing talked about his experience and learnings. You gain experience from other people's experience, but also, nothing beats you investing yourself and learning from that journey. Anything to add, Ser Jing, before we move on?
No, I'd like to use Charlie Munger's favorite phrase, nothing to add.
Okay. Sounds good. So just a quick plug on Endowus, because it is an Endowus live webinar, and wouldn't be amiss without an Endowus plug. So Endowus was set up, and I joined Endowus to build this company up for this precise reason: to introduce institutional framework of investing, and solve these, like, imbalances that exist, for the the unfair disadvantage that individual investors have over institutional investors. And again, it's access, advice, and cost. And we're really not trying to just copycat some US model of a robo advisor. We're really trying to solve for the local Singapore problem in a Singapore way, giving access to institutional share class exclusively, oftentimes bringing funds that were not available here before, and giving real advice that is strategic and passive, which works over the long term, and bringing down costs at every level to the lowest achievable. And that's why we became the first and only advisor for CPF. Sorry, I think something happened. And we're the only digital platform that you can seamlessly invest your CPF, SRS, and cash holistically for the long term. And these are all the things that we do: passive, strategic allocation at lowest cost, globally diversified products, Sing dollar denominated, Sing dollar hedged, 100% trailer fee rebates, which is something that no one had done in Singapore before us. So we get trailer fees, we negotiate a huge trailer fee as much as possible, and we give it all back to the client so that
Sorry,
they
Sam, can I just,
lower.
I just want to,
Yeah,
I just
sure.
want to say that I really love the concept of the rebate of the trailer fees. I think the trailer fees is one of those really hidden costs that investors often don't realize they're paying, and they are paying a lot. And like when I first realized that Endowus was doing this, I had so much admiration and respect. And so yeah, I just wanted to like share my good vibes about like this thing that you guys are doing. Yeah.
Yeah, thank you so much, Ser Jing. It really means a lot because we try to think out of the box because trailer fees is something that is unique to retail funds, right? Institutional funds don't have it. So the original idea was to access the institutional funds and to get to a lower fee. But then as we were doing that, we figured out that actually sometimes it's cheaper to get a retail fund and negotiate a huge rebate. And it goes to show that companies like iFast and DollarDex and all these guys, they live off of this trailer fee, right? And other guys, unit trusts sold through banks and etc., live off of these trailer fees. And we thought, as an independent investor aligned to the best interests of the client, we have to give this back. We can't be paid by anybody else. And this is the way it's done in developed markets. It's often illegal to be receiving these commissions anyway. And this is the way it should be in the future. So we're just moving ahead of the curve, I guess. So thank you for that, Ser Jing. And on the investment philosophy, as we started the company, Greg and Yuning and myself, we really sat down and thought about the investment philosophy. And it's really important to do that as an investor. Really think through who you are, what you want in your investment, what is the outcome that you're pursuing, what do you believe in, and really sticking to these principles that matter. And we try to create lasting investment philosophies, the 8 principles that will work for the individual investor. And these are like proven, time-tested, consistent, holistic, and things that will make a difference in the people's lives and in their investing outcomes. So with that, it's on our website, so people can go and look at it in more detail. And there's a click down, so you can see a little bit more detail on the website. But I wanted to give Ser Jing an opportunity to share his investment philosophy as he embarks on this journey with Compounder Fund, what he's learned, how he developed the investment philosophy. Would love to hear that, Ser Jing.
Sure, thanks, Sam. And yeah, just like to say that Endowus investment philosophy is fantastic. I think there's just, even though like Endowus has a strong belief about passive investing, but I think there's a lot of overlaps because I think we basically believe in the power of the long-term power of the markets, and we really just want people to be able to participate in the general growth of humanity. I think Greg, your colleague once mentioned that investing is about taking advantage of the ingenuity of humans, and I think that's a really great way to put it. So I mentioned the ingenuity of humans also partly because as I started so like my investment philosophy is really about it's built from like the from first principles. It started off with me first thinking about what exactly is the stock market, what is the nature of the stock market. And I realized that the stock market is really just a place for people to buy and sell pieces of a business. And then with this thought, then I started thinking about the next level, which is, what then actually drives stock prices. And I think the most logical conclusion that anybody can come to when you reason from first principles is that the stock price will be driven by the underlying business performances, right? And then then the next level of thought would then be, if stocks are driven by the underlying business performances, then, we should be looking at the companies that can grow at high rates over the long run, businesses that can do well over a long period of time. And so how then do we find such companies? And so this is how I kind of like came up with like my investment framework, which is basically like, the ideal characteristics that I want to look out for in a company. So just I also have an article on this in our blog, The Good Investors. It's under, I think the title is called My Investment Framework. So you can probably Google for that. But just very briefly, I look out for companies that are operating in growing markets, because it's important that, you need to have space for growth. Second thing is we want strong balance sheets. So I think like in the current situation where, the world is experiencing one of its worst economic contractions for a long period of time, this is where strong balance sheets really shine through. And I think one of the really interesting aspects about having a strong balance sheet is that, we don't really know when bad times will happen. So for example, like if you go back 6 months ago, nobody would even kind of imagine that COVID-19 would have such a big impact around the world. There was some news from China that it could be bad for China, but we did not really realize that this could be like a real global thing. No one was really thinking or talking about it, but then it happened. And this is when, the time where companies with strong balance sheets really shine through. And so the idea is that, if I want to be investing for the long run, I need to be in companies that can survive for the long run as well. And so like having a strong balance sheet, which I typically define as having more cash than debt, that would be a really important characteristic to have. Then the next thing I look out for is I want management teams with integrity, capability, and the ability to innovate. So it's really, I spend a lot of time thinking about management, because I think that ultimately a company's competitive advantages, the management team is the real source of a company's competitive advantage. A company's current competitive advantages are the results of management's past actions, and a company's future competitive advantages are the results of management's current actions. So I spent a lot of time thinking, are the management's incentives well aligned with me as a shareholder? How have they generally been thinking about when treating minority shareholders? Have they been fair? How are they compensated? And also like, just looking at how they have managed to grow their businesses, how they think about the world. I really love looking for management teams that have like a idiosyncratic way of looking at the world. So for example, one of my favorite examples is Costco, which does warehouse retail in the US. It lowers its prices. It keeps prices as low as can be, having a very low markup. And even if it manages to purchase its products at a lower cost, it will actually bring down its selling price instead of keeping the selling price at the previous level. And the reason is because it always wants to give consumers the confidence that you can get the lowest possible prices at Costco. And in general, people think that if you keep lowering your prices or you keep your prices low, it's not going to be good for business. But on the contrary, Costco has done really well over a long period of time, and I really love seeing such different and unique ways of looking at the world. The fourth thing is, as in my investment framework, is I like companies with high levels of recurring revenues, be it from customer behavior, like how you purchase coffee or use your credit card, or through contracts. Then very quickly, the last two things, I like looking at a long track record of growth, because I think that companies' past business performance is actually one of its best predictors of its future business performance. There is a certain inherent momentum when it comes to businesses that are winning, that are doing well. Yeah, it's not perfect, but I think it's one of the best indicators we have. And lastly, I look out for companies that can produce strong free cash flow over time. Free cash flow to me is like one of the most important financial metrics. Without cash, the company cannot survive. And the more free cash flow a company can produce over time, the more valuable it is. So yeah, this is like my general investment framework very quickly. Yep.
Sounds good. Thank you. But yeah, we also included the slide about traits of a good active investor. So maybe you can share some thoughts about what your learnings are as an investor, active investor.
Yeah, sure. So I think to be I don't want to use myself as an example, but like in terms of what I've learned from like really successful investors over time, I've discovered like they all have a certain traits. So I think the first one is that they have equal parts humility and arrogance. And I think this is a very interesting aspect, because so to invest well in the markets, you need to have a certain level of humility, in the sense that you need to always be prepared that you are wrong in your views. But at the same time, you also need to be arrogant enough to say that I'm seeing something that everyone else isn't seeing, and so I want to make an investment in this particular company. And And so I think, but you need to balance that, because if you are too arrogant, then you get smashed, you get crushed.
Yeah.
But if you're
Maybe
too,
the right term, searching. Maybe the right term is confidence then, because
yeah,
arrogance, I
yeah,
think maybe it's you don't
too
hear other
negative.
people. Yeah.
Yeah, that's a, yeah, much better. Thanks. Yeah. So equal parts humility and confidence. Yeah, that's a
Yeah.
much better way of putting it. Yeah.
Sounds
Then
good. I think
think,
one of the common biases that people have is confirmation bias and recency
yes.
bias and all these biases that we have. If you're not humble, and I also agree, humility is the most important trait. I think investors need to continue to learn and grow and adapt because the environment and circumstances can change. But you need to be humble enough to continue to learn and grow as an investor. Um,
Yep.
you know, I think Warren Buffett is learning about new industries, new technologies, new companies, even at the ripe old age of whatever he is, 90 something. So I think that's really, really important. And if you don't have humility, you will not learn and grow. Yeah.
Yep. And I think even having humility is also a really good trait to have in life in general, not just in investing, right? So that's
That's
very
right.
good character,
It's
very good
connected, right?
character
It's
trait.
related. Yeah.
Yep, yep. Yeah, then patience I think is also really important, because I think so, one of my favorite phrases, investing quotes, comes from Peter Lynch, one of those legendary investors that we hear about often. He once said that his best gains came not in the third or fourth week or the third or fourth month, but from
Mhm.
stocks that he has owned for the third or fourth year. And so I think this is just a great example of, like, how important patience is. And most of the great investors that I read about or know, they have a lot of patience when it comes to the financial markets. And I think also emotional stability is really important, because the stock market is volatile over the short run. Over the long run, as Sam, you mentioned, it's kind of like a nice outward curve, but in between there's a lot of ups and downs.
Yeah.
And I think that this is where emotional stability is required. You need to be you need to be in a have a frame of mind where you're not carried away by the swings in the market, so that you can continue making smart, logical decisions and not be too swayed by fear. And I think we're going to be talking like later. We have this great statistic about how some investors really fell prey to fear in the last couple of months. And then, yeah, we maybe can talk about that a bit later. And then
Yeah.
the last trait, I think it's it's important to also be an independent thinker. And this is I think very interesting, because I've seen studies. Sam, you talk about biases, right? And behavioral psychology is one area that I'm very fascinated with. And I remember coming across a study that that shows people actually feel like the so when you feel physical pain, certain parts of our brain actually lights up when your brain is being scanned. And they realize that when you're being socially excluded, the same parts of our brain actually light up. So in a way, being socially excluded is can result in the same type of pain as actual physical pain. And
Mhm.
oftentimes, we know when you're investing, you have to sometimes you may carry views that only you carry, and that can be a pretty lonely kind of experience, and it can actually be painful
Mhm.
because of that. And so I think it's just really important that good investors need to have the ability to be independent thinkers, and to have the mental fortitude to be able to stand on their own 2 feet, and carry a slightly different view of the world as compared to the rest.
Yeah, absolutely. Agree with all of your points. It is a really lonely thing when you're investing and things are not going your way. When the market's telling you something different, or you have a team or you work with others and you have a disagreement about views about individual stocks or markets. So it is a lonely, and you need the fortitude and the courage and the strength to stick to your guns, but at the same time have enough humility and flexibility to know that you could be wrong. And it's that kind of paranoia as well that allows you to be a healthy investor. And it really is about managing your emotions just as much as it is about managing risk. So I think the emotional aspect of investing, and making managing that well is so important, because sometimes I've seen people where it actually overruns into their relationships and family and society as a whole, and it's not a healthy thing. I've gone through spates of difficult emotional periods, and it's painful. But it's something that I think you learn to manage better as time goes by. And I think the more successes you have, I think it builds confidence as well. So that's really important. So thanks for that, Ser Jing. We're gonna go to some interesting slides. I don't know if anybody can name all of them. Sergeant, you want to give it a try? Who are
Yep.
these guys?
So
They
from
all look
left
old.
from left to right, John Bogle or Jack Bogle, John
Yeah,
Templeton, Warren Buffett, David Booth, and I think the last person is David Swenson.
that's right. You got it 100%. So Jack Bogle is the founder of Vanguard, legend. I think Ser Jing and I were talking, and he also picked Jack as one of his heroes. And I wrote an article. This picture comes from an article I wrote in the Insights about the true giants of the investing world, because these guys really contributed meaningfully in a seminal way. How we invest today really comes from a lot of these guys. How passive investing, and it's passive and active. I think that's really interesting to note as well. And so I'm going to put in a few more pictures. This is us with David Booth, the founder of Dimensional, and also Senator Bill Bradley, who has 2 MBA championship rings. Amazing. And Dimensional led the way in factor-based investing. And to Ser Jing's point, David Booth began in the 70s in his small apartment. So it's like an Apple story, right? So Dimensional was tiny, and they started as a small cap focused factor-based investor, but really focused on bringing academic research and excellence into investing. And they are one of the biggest players in the asset management world. This is me with Ray Dalio, Bridgewater. And I wanted to point out that these guys were one of the best practitioners of diversifying risk. They brought into household, vernacular terms like risk parity, all-weather investing, quant investing. But to the point earlier about how great performance don't always last, in a new normal, these guys in the past several years have not been performing, especially since Ray is kind of semi-retired and doing a lot of other stuff. But I wanted to highlight that. And these guys also, all three, Ser Jing, I know. So I'm not going to even bother asking you.
Yep.
But
So yeah.
sorry?
No. Go on.
Yeah. So basically, I wanted to, we've done this before, and Warren Buffett. You can name them, Ser Jing.
All right. Warren Buffett, George Soros, and Jim Simmons.
Yeah. So Simons, yeah. But yeah. So these guys are legends. And most people obviously choose Warren, like who has the best returns. Warren has the longest, track record. But if you look at the numbers, actually, it's Jim Simons. And people who are real fans about, investing and learning about investing, actually, he is the founder of Renaissance Technologies, which is the most successful quant fund in history. And that's why I think it's really important to have a philosophy, have a system of investing when you are an investor. So we wanted to touch on this. Ser Jing brought this up, but I actually presented at NUS a long time ago about this particular topic. Ser Jing, you want to have a quick
Yep.
discussion about this? Yeah.
Yeah, sure. So I think this so like I'm this is about etymology, which is basically the source of words, where words come from. So the English word for invest, invest, the English word comes from the Latin word called I'm hopeful that hopefully I'm pronouncing it correctly. It's called investere, and it means to clothe. And the idea is that you put on something and then you are with it for the long run. And so it gives the source of the word. It's kind of signifies that investing is really something like that you do for the really long term, and that you stick with for a very long period of time, because you put on something and then it stays with you for a long time. Whereas when it comes to the Chinese word 投资, the word 投 is it means to throw, and the word 资 means money, and it kind of like literally translates into like throwing money. So I think this is a very interesting difference in terms of the etymology of the word, or the word invest in English and in Mandarin. And I think it's kind of reflected perhaps in a way. So I've also seen studies, and I'm not too sure if this is true, but like, when you think about a topic with different languages, you tend to have a slightly different way of thinking about the same topic. And so I'm not sure if this is really the case, but if you look at statistics showing Chinese investors and American investors, we can see that Chinese investors actually trade way more than the Americans. And for all we know, perhaps it's something to do with the etymology of the words. Yeah.
I think it's really important. And, I talked about this as well before, but, it's Chinese. but the Japanese use the same word. Obviously, Koreans do, Taiwan, Hong Kong, Singapore. So it affects all of Asian investors, and that's why there's a lot more kind of a gambling or trading kind of mentality that exists. And maybe this is partially to do with it because of the way we understand. And it goes back to Ser Jing's point about being truly vested. When we say we're vesting, it's really about being involved and being clothed, owning something rather than just trading or going in and out of stock. So it really is important to be long term and be, very philosophical, systematic about your investing. So now I want to go deeper into the active passive debate. So I'm going to go through a few slides that I think touches the basis of it. And guys who are listening, thank you so much for joining us today. But if we could have some more questions about the topic about investing and active and passive. Thank you for your questions on Endowus. We may not be able to answer it because we have other sessions on Endowus. Today, we want to focus on active and passive and investing as a whole with Ser Jing here. Please reach out to support@endowus.com and reach out to our reps, and we'll answer those questions later if we have more time. But we will focus on the questions that are relevant. I saw a question about your returns and whether the returns included your cash. I think Jimmy or somebody asked that question, but we'll come back to that when I mention cash later. Right now, I just want to delve into active versus passive in a bit more detail. So I'll go through these slides really quickly, and then we'll talk to it a little bit. So active outflows almost identical, but the top line is not apples to apples. So it's interesting that equity mutual funds in the US actually grew much faster than ETFs. So everybody thinks passive and index is really all about ETFs, but it's really mutual funds in the US. So it's a very common way to do it. And it's the way we prefer in Singapore at Endowus because a lot of ETFs here in Singapore are very inefficient because of the withholding tax. Somebody, I think Gora was somebody mentioned earlier about the withholding tax issues, but you are subject to 30% withholding tax on dividends in the US, and you may even have inheritance tax issues if you, God forbid, anything happens to you and you may not be able to access your money in the US, and you have FX cost many different costs involved in investing in US ETFs as opposed to Singapore. So we try to solve that problem by accessing the best solution in Singapore, which are tax efficient, Sing dollar denominated, to make it easier for the individual investor. There are actually good DIY options as well, but for the average individual investor, it's really something that is really not that easy for them. So Endowus has really tried to solve that problem. But really, the flow from active to passive has been tremendous. But it's also been driven by natural growth in overall equity allocation. And then this is another one that's really interesting because in the US, if you take out S&P 500, it's really not that much flows into passive. And so S&P 500 is very dominant, and we'll talk to that later. And two allocations really dominate all of the flows. One is the Vanguard Total Market, and the other one is the S&P 500. And most people don't know that Vanguard is actually the largest in the US. BlackRock globally is the biggest fund manager, but they have a lot of different allocations. They have institutional money, but for retail mutual funds, Vanguard dominates that piece. And then that was 12 years up to 2018. 2019, they were again ahead of BlackRock. And I saw a number recently on 2020 year-to-date numbers in first quarter. Vanguard again dominated in attracting the flows, largely because it was retail. It's regular people. I just wrote an article in Insights about markets and about how the big winners of 2020 have been retail investors. People talk about Robinhood investors and trading guys, but also, retirement, old age people who, have been regularly saving and investing in Vanguard funds have won out. And they really dominate the market there. So this is a chart that we use and many people use because we want to show that it's not easy to be a winning active investor. And we hope that Ser Jing is one of those winners, but it's not an easy task. And it really is about the persistence of returns because the guys who are winners oftentimes don't remain winners. And I think it's really about the problem of trying to outguess the market, even as a professional investor, continuously having to outperform. and in different cycles. But because we've seen only a very strong kind of upcycle with hiccups, haven't really seen a true extended downturn and how factors rotate or funds have performed differently over time. So just wanted to put it here. And Serging, interrupt at any time if you have any comments. I'm gonna flip through these slides. You can comment at the end or you jump in anytime, just shout out. Yeah. Um, and so what do the experts say about active and passive investing? Wanted to touch on this because active managers consistently underperform, as we showed. And it's about, sustainability of returns. But it's really this second point about the reason they underperform where there's a lot of debate. So the Chicago Booth School, interestingly enough, David Booth, the founder of Dimensional, donated a lot of money to Chicago Business School and named it Chicago Booth. They have research and they say that professional stock pickers and um, efficient market hypothesis guys will adhere to this is that professional stock pickers, even if they do beat the market, it's really just pure luck. Monkeys throwing darts at the board will pick just as many good stocks rather than being skilled. But the reality is that no shortage of money managers who claim to beat the market, and some really actually do have impressive track records. We talked about some of them: Warren Buffett, George Soros, and Jim Simons, and the likes. And those are active managers. How do we reconcile this? And recently, there have been studies that show that from the Chicago Booth School, no less, Dr. Pastor actually showed that money managers are actually quite skilled, and this is the actual data over a long period of time from 1979 to 2011, removing the size effect. They researched over 3,000 funds, and they showed that actually typically the investment performance actually improved. So the average skill of outperformance improved over time, and it was most pronounced in actually sorry, but the problem is that these periods of outperformance didn't last, and that is hard to maintain the market beating performance. And often the reason for that is for these reasons. One is industry effect. As the industry grows, it becomes much more competitive. The second is the victim of its own success effect. Size does matter in this case. When you're smaller, it's easier to outperform. When you become really big and you're successful and you gather billions and billions of assets, oftentimes it's difficult to replicate the same investment strategy. And then the final point is fees. So we'll come to the fees, but I think it's really important to maybe just pause here and get some thoughts about these studies and what Ser Jing thinks about active versus passive investing and a lot of this research that has come out, because it is possible to beat the market. Like in hindsight, you look at these 5 stocks and say, oh, the biggest stocks in the index right now, if we had owned it, it would have beat the index. So it's really easy to talk about things in hindsight, but making the bets in at the right time, through this volatility. So you talked about the volatility, and also being able to stick to it, because most oftentimes the mistake that we make is we sell too early. So at this point, I want to hand back to Ser Jing and maybe hear from Ser Jing about thoughts about these different studies and also active versus passive as a
Yeah,
weighing of.
sure. So yeah, I mean, I have not seen. I think you've shared some really good, interesting statistics. I think the best not rebuttal, but like I guess the other point of view would be actually I think I would bring up one of Warren Buffett's most famous speeches, which is the Super Investors of Graham and Dodd's View. So that was a speech Buffett delivered in the 1980s. I think it was 1986. In the mid 1980s. The exact year I can't remember too well now. But in the speech, Buffett shared, I think it was 6 or 7, or is it 8 individual investors that he knows of, including himself, that have done very well over time. And he kind of traced them all back to a common source of knowledge, and that would be Ben Graham. So the people that were part in that speech included Charlie Munger, Bill Rain, Rick Guerin, Walter Schloss, and a couple of others who I can't remember now. But the idea was that all of them had either worked for or had kind of in some form or another trained under Ben Graham. And so Buffett kind of used that as an example, that saying that, if you approach the stock market with a certain type of mindset and certain type of mentality and framework, then it is possible to beat the market. But I also think that it's getting increasingly difficult. I think there's this investor named Michael Malbossian who writes fantastic research. He kind of made this very interesting point in that, like, the growth of passive investing can actually make active investing even harder, because it kind of pushes out more and more active investors. And so the people that are left in the game end up competing. So it's, for example, like if I were to use a analogy, like, if I love football, so like if I'm playing football, you have like Lionel Messi and Cristiano Ronaldo, who are like excellent world-class football players. And sometimes when they play against lesser teams, they can dominate them very easily. But what happens if you start pushing out all the professional footballers and you're left with basically two teams that are all like at the same level? One team of Lionel Messi's and one team of Cristiano Ronaldo's. And when they play against each other, it just becomes so much harder to win. And I think that there's also like an element inside there. But that said, I think that it is very much still possible to outperform if investors can adopt a certain type of framework and thinking about the markets. So I think like I'm a big believer that there are many roads to Rome. Jim Simmons, he's such a different investor from George Soros, and such a different investor from Warren Buffett. And like Soros, Buffett, and Jim Simmons, they invest in very, very different ways. And so I think these are like fantastic examples of like, how there are many different roads to Rome. But I think that one of the easiest ways to achieve success is really just like having this very business focused mindset, not thinking too much about what's happening in the broader macroeconomy, but just really drilling down and looking at and trying to understand and find really good businesses. But that said, I also realized that, sometimes different people come to different views about the same companies. One of my favorite examples, there was this, so there are two investors with really good long-term track records in the US. One is Chuck Akre, who runs Akre Capital. The other is Monish Pabrai. And I remember this example really clearly because there was in March 2000, in 2019, Monish Pabrai was interviewed and he was talking about, asked about MasterCard. And he said that, MasterCard is a great business. Everybody knows it, but it's so expensive. He wouldn't touch it with a 10-foot barge pole. And at the exact same period of time, there was Chuck Akre, who has MasterCard as either his top or second top position. It's like a 10 or 15% position in his portfolio. Both are highly, highly successful investors. And yet, they look at the same company and they come to a completely different view. And so I think that there is perhaps sometimes some people are perhaps just a little bit, they are able to see the world a bit differently. Like, I brought up the point earlier about management teams who can see the world a bit differently. So I think that maybe, there's just also some form of innate talent that is involved in this. So perhaps you can train for it, but like, if you really want to make a huge difference, if you really want to kind of like make a huge dent or huge difference, then perhaps it will boil down to some form of a talent or an ability to see things that others cannot see. And one of my favorite quotes about investing that I've been using a lot lately comes from this philosopher named Arthur Schopenhauer. And he says that, the task is not to see what everybody sees, but to think about something that no one has yet thought of about that which everybody sees. So the idea is that, how can you look at the same piece of information and come up with differentiated insights? And I think that is perhaps one of the most important skills that somebody needs to become like a really good investor. And if I look back at the long-term track record of like the investors at the Motley Fool, like David Gardner again, just tremendous success year after year. And so I do think that it is possible to beat the market, but you need to have I think first you need to have a really good investment framework, and then you need to have some luck in terms of being able to bond with a certain amount of talent, being able to see, and being able to think about things that nobody is able to think about.
Yeah, no, wonderful sharing. And it's interesting you mentioned Michael Mauboussin. He wrote the book The Success Equation, which is untangling skill and luck, right? So it's precisely on that point. And he used to be a strategist at Credit Suisse when I was at Morgan Stanley on the buy side. So he was on the sell side. He wrote some really good research and a lot of stuff on behavioral finance. But his book is really good. And I think, once again, you showed how well read you are, Ser Jing, by mentioning all these books and people. But once again, I can't emphasize that reading about people that no longer are there, but also books like from Michael, which are really good books and easy to read. It's really important for people to take ownership of their investing. journey and to learn from the greats. And as you said, I think every investor is different. So if you look at the way these great investors invest, they're actually very different and unique. And it's not a very simple formula. It's not like I was a value investor and that's it. Benjamin Graham, Graham and Dodd book, security analysis, and that's it. There's no magic formula in there. It's actually how you interpret it. It's the emotions, it's the skills, and some dumb luck. Sometimes we have to admit that sometimes we're lucky, and
Yes,
luck
luck
is
is
a skill set as well, we
super
say.
important. Yeah.
And another really important thing is that you mentioned Peter Lynch. But a lot of the great returns of history and great investors were investors who met the right time. And so Peter Lynch, in that period, it was the best period for bottom-up stock picking. It was the roaring 80s or whatever it was. So you have to meet the tailwind of good markets to generate the long-term returns. But also, that discipline is really important, and humility in achieving that long-term returns. So, Jin, you're going to say something?
Oh no, I was just gonna you were talking also a bit about like the one of a few reasons why some active managers perform and then end up not performing, right? And I would like to add on a point in that I think sometimes it also boils down to so I think it's really easy for people after they've tasted success in the financial markets to think that they are better than they really are. So I think what a lot of people don't realize is that being a good investor does not necessarily mean that you know everything there is to know about the financial markets. Like I get a lot of questions from people asking me what would the US president be doing, or like how would the economy change and stuff like that. But these are things that I have no idea and I do not know. But assume that I do because I've had some small success in picking stocks well. And so what I think is that sometimes investors, after they have tasted success in a certain type of investment activity, they start developing a really big head and think that I'm really good at, if I'm so good at this, I'm going to be very good at that. And then they try, and then I've seen a lot of cases where they stray from their initial ways of investing, and then they end up doing really badly. I think a really good example would be perhaps John Paulson, who made a huge amount of money during the housing crisis. But what's really interesting is that John Paulson started off as an arbitrage investor, and then he made this macro call on housing. Not sure lucky or it was really good insight, but after that he started doing things that were not related, mostly not related to arbitrage, and he has not done well ever since the financial crisis happened. Yeah, so I think that's just a good example of how when you start straying away from your circle of competence, that that's perhaps another important reason why successful managers then become unsuccessful.
Yeah. Hey, Ser Jing, we have a question from Michelle Tan asking about books. What are some really good books for beginner investors? I'll choose one, which is Jack Bogle's Little Book of Common Sense Investing, which is a passive investing book. Why don't you choose one? What would you, choose? You can do a couple if you want.
I will go with two. So I think the first is it's very important to understand behavioral psychology, how our mind often plays tricks on us. So I think the first book I recommend is Thinking Fast and Slow by Daniel Kahneman, a Nobel Prize winning behavioral economist. And then the second book would be Peter Lynch's One Up on Wall Street. That's one of my favorite books.
Okay. So the second one is a stock picking book. The first one is a psychology book, to be honest.
Yep.
Not necessarily about investing.
Yep.
So please note before you jump into that book, but it's a really good book, regardless. So just going through, some more slides at the moment. I wanted to get to this issue of cost, why fees are so important. And this is the impact of the different, active funds generally tend to be more expensive. So Bill Sharp wrote this seminal research in 1991, I think, the arithmetics of active investing. And it's like the golden standard, what everybody looks at. It's a very simple, idea that fees actually eat into returns long term, and active investment, in general have higher fees. So it's a bigger hurdle to overcome, whereas passive investing is much lower. And Morningstar at the bottom had a survey previously Morningstar used to rate their funds in number of stars. So 5-star funds were the best funds, but it really was most influenced by the past 3 years best performance. But the persistency of that return didn't live up to expectations, because many of those fast 5-star funds consequently went on after 5 years, only 17% outperformed. So it was actually best to sell those ones that were the best performers. In the case of funds, in the case of stocks, we believe that you need to hold on to the winners, right? That's the rule, and sell your losers. It's counterintuitive. But for funds, it's actually the other way around, that you should sell, your winners, because that return is not consistent or persistent. So they did a study, and they've now put in expenses and expense ratios as one of the key drivers of how they rate the funds. So it's really important, and it makes a meaningful difference to your returns. Improving returns by 1% is really, really difficult. As an active investor, we know how much we need to make an effort to improve returns by 1 percentage point above an index. But lowering costs, if we can lower costs by 1%, and especially because retail individual investors struggle to gain access to the low cost products, this is really pertinent, I think. And so just a few more slides. Active funds, the big outflows have actually come from the more expensive active funds. So this is really interesting. The good news is that fees are all coming down, active funds and passive funds. The bad news is that because they're coming down together, the gap between active and passive hasn't really narrowed that much. But long term, it is narrowing, which is good. But long term, we need to do more. And from the Endowus perspective, I'll mention a few things, and then Ser Jing, you can mention from compounders perspective as well. About cost is really important, because for us, it really is about bringing down cost in a very inefficient market like Singapore. So we want to bring down cost to the lowest level because the industry is so broken. So especially for unit trusts, there's so many fees that are being taken out by the regular channels, distributors like banks or brokers or advisors. Even if you try to do DIY on platforms like iFast and DollarDex, that middle part, the fund level fees, have embedded in them the trailer fees, which are oftentimes make double the cost. So Endowus with UOB Kay Hian has brought cost down to below 1% all in. Our 100% equity fund is now at 0.4% fund level fees, using Vanguard funds, Dimensional funds, and PIMCO funds for fixed income as well. So it's really amazing what we've been able to achieve. And we have cash. This is cash, SRS, and CPF. But CPF also, we brought down cost by a fraction. And really, this is really important, because we do feel that the biggest generational challenge we face as a society is really this retirement adequacy, the shortfall, and the shortfall in the pension. So CPF Life may not be enough for you, and so you need to invest your OA money, which is only getting 2.5% for the long term. And CPF is perfectly suited for you to invest for the long term, dollar cost average, and invest for the long term. The money's stuck in there for you. So I think it's really important that we emphasize how important cost is. And even robo advisors who purport to have really low fees, they have really low fees at the ETF level, but then that's it. Everything else, which includes withholding tax, the bid-ask spread, and the FX transaction, actually, build up to a meaningful cost, and is higher than Endowus as well. So, individual investors suffer for that reason. I think cost is one of the major reasons, and they, leads to poor outcomes, but also behavioral mistakes, because they chase rallies and sell at the bottom, or hold too much cash. At this point, I think, Ser Jing, if you can talk to some of these charts about cost,
Yep.
Your thoughts about cost and how you're doing fees. You're kind of like an absolute return, active fund, but you have reasonable fees, and I know you want to do good for society, so you're giving some of that away. So I don't want to steal your thunder, but can you share some more thoughts? And
Sure.
then maybe also go with that first, and then I have a follow-up question from one of
Yeah,
the
yeah, sure, sure. Thanks. Yeah, I mean, I completely agree that fees are one of the big problems why actively managed funds have not done well. Net returns to investors have not been as good as passive funds, and I think a lot can be traced to fees. I think so from that perspective, passive investing is awesome. It's wonderful because people can get instant diversification at very low cost, and again, like I think all the work that Endowus has been doing to bring the total cost for investors down to 1% or below. I think that is really really good for the broader community in Singapore. And I think that's really wonderful. So for us, at Compounder Fund, we also we care very much about cost. For us, when we were building the fund, we wanted to kind of like let people think about a different way of thinking about fees for the financial services industry. So for us, we have a management fee and a performance fee at launch, but both of these will actually decline as our assets under management grows. So our management fee at the start is 1%, but that would decline to 0 or 0.2%, depending on the share class, as our assets under management grows. And at the same time, for our performance fee, we have in place what we call a hurdle rate, meaning that, we only earn a performance fee if and only if the fund's return actually comes above that hurdle rate, which is a 6% compounded hurdle rate. So essentially, like you can imagine when people start investing in the fund, there's a 6% compounded hurdle line that's drawn, and the value of the fund needs to be above that for us to be able to earn a performance fee. And on top of that, we also have what we call a high water mark, which means that every time we hit a new peak in value, there will be a new 6% compounded hurdle line that's drawn. And so I think this kind of like incentivizes us toward thinking about long-term performance. It's not just, we do very well for 1 year and then after that we can just coast and sip cocktails in on the beach. No, that doesn't work this way because we have to continue beating a new hurdle over time. I think this is one of the this is just perhaps our way, to kind of introduce the thinking in terms of like paying for performance, at the same time paying for long-term performance, and also trying to keep costs as low as possible for investors. Oh, and by the way, before I forget, I think it's very important for me to also just mention that the Compounder Fund is only open to accredited investors. This is a regulatory thing. I think I kind of forgot to mention that at the start, but yeah, just wanted to make it clear. Yeah, so Sam, you said you had this follow-up question with.
Yeah, it's about that cash question since cash drags performance quite a bit.
Yep.
Somebody earlier was Jimmy W was
Mhm.
asking impressive returns from Ser Jing, but does the calculation also take into account the undeployed cash on hand while waiting for
Yep.
investment opportunities?
Yeah. So I think correct me if I'm wrong, but Endowus also believes in being like more or less fully invested at all times. Am I
That's
right to
right.
say so?
Yeah.
So I think on this again, we share so much similarities because I also believe in being fully invested at all times. So my performance calculation actually includes cash, but that's because my cash position is more or less zero at nearly all times. So there's no cash drag, so to speak. And the reason why I like to be nearly or fully invested at all times is because there are very good statistics that show that if you miss just a small handful of the best days in the market, then your returns just really plummet. And we don't really know when these best days would happen. And so I think it's just really important to stay invested for the long,
Mhm.
so that we can give ourselves the highest possible chances of success. And I think I mentioned earlier about the whole idea that one of the key reasons that I believe active managers underperform after a period of success is that this issue of ego. And so I think that it's really important for us to be investing in a way that where we know what we are good at and what we are not good at. So I know
Mhm.
for very well that I'm not good at timing the market. I do not know when to jump in and out of stocks. I do not know when the market is going to be reach a high. And so because of this, I just want to be nearly fully invested for as long as I can. Yeah, and so yeah, that's to answer the question.
Yeah, no, and it tees us up well for the next few slides because this is unfortunately something that came out recently from Fidelity about individual investors who sold off all their equity holdings during the period of February to May, which was just before the collapse, all the way down, and a part of the rebound, not the latest move up. And, especially for the older age group, they've sold down almost 30% of their equity at the bottom. And for all investors, that's, 10 to 15% for the remaining age groups, which is quite a lot. And it's very unfortunate. These behavioral mistakes of selling at the bottom is really unfortunate. And it's really important to look at this. I mean, there is volatility, but equities is a growth asset class. And because the market does its job, which is sieving through the best companies, the 5 companies we mentioned, they're the ones that win out because the market is pricing in all of the information available to sieve out the best companies. And then, reasons to sell always exist, regardless of where we are in the point of a cycle. There's always negative news to deal with. But, it's been the right thing to be invested. So Ser Jing mentioned about being fully invested and investing for the long term. And, even in the throes of the bear market, although it feels bad, the mistake is that we actually don't remain invested, and we miss the initial bounce. So some of the biggest days happen at the bottom of the bear market, or when the things are starting to turn. So if you miss that, then you've missed 10% of the return. Or if you miss 10 of those days, you've missed 25% of the total returns of the bull market. And so I think it's really important that being invested means you give yourself a higher chance of success. And many of us have income, a continuing income, and that plays into the dollar cost averaging theme. And I wrote an article on the weekend about lump sum versus dollar cost averaging. And maybe Ser Jing, you can share some thoughts about that. But historically, data, because the market does this, if you remain out of the market, you're always going to be chasing the market. So a common mistake that we make, and it's a trick question, if you ask somebody, what happens after the market peaks and hits a new high? Everybody thinks because of the word peak, then it will fall, right? Is a natural response. But actually, after the peak or a new high, the most natural thing to happen for a market is another new high. So statistically, that is the empirical evidence. After a new high, there are more new highs. And the problem in that scenario is that you sell too early. And Ser Jing, being a patient investor doesn't mean that sometimes the stock does badly or markets fall and we have to be patient. Sometimes patient means the company really fulfilling its full potential, tracking the company, understanding what it's achieving, and sometimes sticking with that company for the long term to reach its full potential, whether that company is called Netflix or Amazon or Google or whatever it is. That's really important. And the bull markets tend to be much longer. And the biggest mistake individual investors make is selling too early. So just want to say anything there, Ser Jing, before we move on?
Yeah, no, I mean, like the point that you brought up about the investors exhibiting bad behavior, selling nearly rather selling all their stocks, I think this is why I brought up the psychology book as one of the books that beginner investors need to read, because like the whole idea of psychology is also really important. Today this topic about active versus passive investing, but I also like to just share this point of view that I think, Sam, we talked about this as well. It is that people often talk about active and passive investing as like the vehicles that they choose to use, right? Passive investing means you're looking at passively managed index funds, and active investing means that you're trying to like pick stocks or jump in and out and stuff like that. But I think it's also important to realize that you can use passive vehicles to be active investors, in the sense that you're trying to jump in and out of the market. But by doing so, you're actually exhibiting like really bad investment behavior. And so it's also important to think about whether your behavior is active or passive. And I think that for me personally, at least, I think that having a passive behavior when it comes to investing, it's way more important than choosing an active approach or a passive approach. But the behavior needs to be passive. And like some people call me as an active. They say that I'm an active investor, and that's true because I pick stocks. But I would say in terms of behavior, I'm passive, and in fact, I think a lot more passive than a lot of the so-called passive investors who own passively managed index funds, because they jump in and out. But that defeats the purpose, because even invest in a low cost, a really good low cost product, but if you're not there, you're not present to take advantage of the long-term growth of economies and businesses and markets, then the whole idea of active or passive just it becomes a moot point, because you're not there to take advantage of that. And
Absolutely.
yeah, it boils down to investor behavior. Yeah.
Yeah. No, I really like the way you phrase that because passive investing is not just about an index because you can have a very active index because index is something that you create. Passive investing is a mindset and a philosophy, right? And I think Ser Jing, you exhibit a lot of the right characteristics, things that Warren Buffett would be very proud of. And precisely for that reason, Warren says that for professional investors, you can be active managers of your money. But for 90, probably 95% of the population, would you agree? Maybe 99, I don't know. I would probably go with 99 in hindsight, looking at the track record of all the
I-
active investors
I'm a
I
bit more optimistic. I'll go with 85%.
85%? Okay. So 85% to 99% should be going with a passive, strategy or passive product. And really passive, I mean by broad passive, being exposed to the total market. Some people think just being an ETF is passive, but it's not. There's more ETFs than stocks now, right? So it's really, is not the right way to do it. And Sturgeon, you raised a really important point about how you can use passive products, but be really active about it. So you can trade in and out of Chinese internet, ETFs, or hold too much cash, and that's an active bet. And then go into the market, come out of the market, time the market. That's a very active mentality. So I think it's really difficult to really pinpoint one over another. But I think being passive, whether it's at the instrument level or passive, in your philosophy and emotion, like you said, or being passive, at the strategic asset allocation level, which is what Endowus does, is really important too. And this chart really is about that: being passive and globally diversified, and being strategic makes sense versus being very concentrated or active in your market timing or going in and out of passive strategies like some guys do. But also because in Singapore, we are conditioned to, buy STI sometimes. A lot of people do that and think it's being passive, right? And I mentioned the super terrible index, right? So Jing, you hadn't heard about that? Super terrible
No,
index.
yeah, it was the first time. I mean, this is the first time I've heard about the STI being the super turbo index, but I think that I love the name.
Yeah, so it's our friend Lou who came up with the title Super Terrible Index.
Right,
But
right.
it's not that the companies are terrible or Singapore is terrible. We're not bashing Singapore at all. I mean, great companies, some lasting companies with good yield. But if you look at this picture, Singapore, where is Singapore? Is less than 1% of the global market. And if you think about the opportunity set out there, and that's why I like the fact that Compounder is a global investor. You get the best companies around the whole world, with the traits and the characteristics that you're looking for. It just is a much bigger, wider pool, and those companies tend to be the ones that become bigger within the index. And that's why passive investing works, especially for equities. You can actually be betting on the best companies by still being an index player. And that's why I think it works even as a passive investor, especially when you're not a professional investor. And this is something that we talked about as well, the lost decade syndrome. S&P 500 is always touted as the best index, and it is. Amazing companies, the best companies. It's actually quite diversified. 60% of the revenue comes from outside. So S&P 500 is one of the best indexes, but it's not the best all the time. So post the financial crisis, post the dot-com bubble bursting, it not only underperformed this period right here, 2000 to 2009, and S&P 500 is here. Great performance before and after, but for a whole decade, it not only underperformed, but it was negative returns. So if you had invested in S&P 500 in 2000 and remained invested for 9, 10 years, you would have had a negative return, which is a horrible experience to have as an investor, right? So I think these things we need to know, and to have this longer term perspective. Even now, I think people talk about this market, this cycle, and it's almost seen as one cycle, one bull market, right? We've had hiccups, but we haven't seen a full down cycle as yet, a proper one at least. So I think it's difficult to think about where we are. I'm not that bearish the markets, and I'm assuming, Surging, you're not either.
I'm actually agnostic when it comes
Okay,
to markets.
obviously, you're a
I'm
stock
looking at
picker.
companies. Yeah.
Yeah. But there was one guy, one person who asked a question about what you thought about this overall market being such a long bull market. Do you
Mhm.
have any views about the market or?
I think like if you look back at statistics, there have actually been periods of much longer periods of bull markets in not just the US but like other parts of the world as well. So I
Mhm.
think it's like there's no fixed schedule, there's no clock. Like
Yeah.
you talk about recessions and people always say, I mean the US is currently in a recession, but but that's because of COVID. Before COVID-19, there was this idea that when would the US enter recession because it's been 10 years since there's been a recession, but Australia was
You see this chart, Ser Jing? So the
sorry.
80s to the 2000, that cycle,
Mhm.
right, was a longer
Ah,
cycle.
yeah. That's right.
Yeah.
That's right. Yeah.
And this
So
is
like
to Dennis's question about S&P being a perpetual bull run. So
yep,
answering that question.
yep. And yeah, I was just gonna say that Australia had I think what 25 years or something without a recession.
Yeah.
So like these things can happen for longer than we think possible. But yeah, I think the most important thing is like just keep having that long term view in mind. We are investing. We're here. Most of us are here investing for decades. Even for people who are like 60 years old, life expectancy is increasing. They still have, and I think Greg also brought up this great point in
Mm.
one of his webinars that even if you're near retirement or at retirement, you still have decades to invest because you cannot not just be you can't just leave off your savings. You still need to continue investing to produce returns unless you can leave off your savings if you have like a huge pile of savings. But for most people, that's not possible. So you still need your
Yeah.
savings to be actually producing, to still be productive.
Mm.
And because of that, like having that long-term mindset to invest would still be really important because yeah, technology is improving. People are going to be living longer for a much longer period of time.
Yeah. Sounds good. And that's why we work with some of the best fund managers. I think Michelle or somebody asked, oh, Lisa asked the question, do we only work with Vanguard? We work with everybody at Endowus. We try to choose the best in class product. So we're agnostic to product. We don't just choose ETFs. We can use ETFs, we can use index funds, we can use active fixed income products like PIMCO. And the reason we don't use passive as much in fixed income is because 1/3 of the global market is a negative yield. If you think about what fixed income benchmarks are, as opposed to equities, which is the best companies end up being the biggest index portion. If you think about debt, the companies who issue the most amount of debt actually are the biggest index constituents. So it's a very different concept, and so PIMCO, which is the largest fixed income manager in the world, and Dimensional, who has a systematic basis of investing in their fixed income, we choose funds from them. And combined, our partners manage $11 trillion. And I also included the compounder fund at the bottom, searching for you. That if one day you guys grow as Dimensional did, and you have great track record, we would want to include your fund as well at the right time if it's suitable for our investors. So look forward to that moment. This is the
Awesome.
cash question because a lot of money flows into money market funds. I did want to ask, how you manage your cash within the portfolio. Um, how everybody is kind of scared, and there's a lot of
Mhm.
money sitting on the sides and waiting to go back into the market. And so people are less familiar with money market funds in Asia, but in the US, and developed markets is a very common way to manage your cash. Is that something that you're looking at, or how do you look at and manage your cash? Is one question that some people had.
Oh yeah, so I think like I mentioned earlier, I'm very much a big believer in being nearly fully invested at all times. So like in terms of managing cash, I don't put too much thought into it. It's more important that I'm able to find attractive investment opportunities.
Mhm.
And I think even in this current environment, if we look out 5 to 10 years from now, I think there's still plenty of really exciting, attractive, innovative companies to invest in. So
Yeah.
in terms of the managing cash, that's not something that I really put a lot of emphasis on because yeah, we are just we intend to be nearly fully invested at all times.
Okay, sounds good, Sir Jane. I don't think we have any other questions that are relevant that we can answer. Oh, in hindsight, given the volatility we have experienced year to date for 2020, what would you have done differently? And I'll put the slide up because it's one of my favorite quotes, and it speaks to Ser Jing's point about patience. The stock market, Warren Buffett said, is a device to transfer money from the impatient to the patient. And we're about patient investing at Endowus and also at Compound the Fund. So we're very aligned in that way. But this interesting question from Michelle Tan. In hindsight, given the volatility we have experienced here today for 2020, what would you have done differently? Is there anything?
Not from me actually. I made no changes at all to like the investments that I'm managing.
Yeah.
None whatsoever. So like I was just watching the whole thing unfold. I was very much confident of most of the businesses that I'm invested in, and so I did not see any reason to make any changes to my portfolio. And yeah, so like if you go back to like the chart that my family portfolio has, we don't need to go back, but like uh,
Yeah.
if you can look at it from my website and stuff, you notice that like the value of the portfolio is actually higher today as compared to the pre-COVID-19 peak in
Mhm.
2020. And that is a result of just pure patience. I did nothing at all. So
Mhm.
yeah, I don't think there was anything that I would do differently.
Okay. Did you pick up anything at the bottom, or did you find some new ideas during this 2020 period? Did you add any new names?
I did not add to anything. I mean the in terms of my family's portfolio,
Yeah.
I made no changes to anything.
Okay.
But I think I kind of found a few more interesting ideas because of like the huge change when it comes to
Mm.
digitalization, and then that kind of like got me thinking about like some companies that could be really on the
Mm.
really benefit and not just benefit for the short run, but benefit for the long run because now all of a sudden people are being forced to adopt technology, and oftentimes I think when people adopt technology they realize that it's a much better experience than like what they were used to, and so it's very hard to go back to the way things were before. And so like I think for some technology companies, like once people adopt their services, the users tend to be sticky, and so that's a net positive for them. Yeah.
Yeah. And I think oftentimes these companies, and they've gone up a lot of the good ones, right?
Yep. Yep.
But oftentimes the mistake is not chasing it because people underestimate the impact these things have in the second, third, fourth order,
Yep.
and these winners continue to be winners, right? So I
Yep.
think it's important to do your work, not be too worried about valuation. Valuation comes secondary to business models, good management, growth industries and stuff that you mentioned. So that's important. And to Michelle's question for Endowus, for 2 years, we didn't make any changes to our portfolio. We're strategic and passive in asset allocation. We really believe in being globally diversified. That's the true way to be passive. A lot of other guys out there, and robo advisors included, talk about being passive, but most of them are not. Very few are. And so being truly strategic and passive in asset allocation and implementation is really important. We recently changed our portfolios, first time in 2 years. But the only reason we did that was not because of any changes in the market, but because we found better products to replace the existing funds to that represent the underlying geographical or asset allocations. So all we did was upgrade the funds to better funds and oftentimes lower cost funds. So we were able to lower the total portfolio, whether it's cash or SRS, and including our CPF. And our CPF, we're the only ones out there who have a Vanguard managed passive index fund. So would you believe CPF did not have any passive index funds in their fund list? So Endowus worked with Vanguard and our local partner Lion Global to bring in Vanguard managed passive index funds for S&P 500 and global equities for the first time into CPF, and at the lowest cost achievable, which is 40 basis points and below, and again all in costs are below 1%, and it is exclusive to Endowus because we're the only ones who are giving the 100% rebate in trailer fees once again. So we're doing what we can to improve the industry and the opportunities that are out there to give you the best chance of success. We do it with a very high ethical standard and a real sense of fiduciary duty. I think that's really important for all investors and all fiduciaries of client money. So with that, we've run out of time. So we've gone over our time. So apologies for people who are online. Please go look underneath our YouTube. There's a link to the Endowus link. I think there's a link to your Ser Jing articles or places, maybe not, but we have the Good Investors link is there.
Yes.
Also, we have Eventbrite sign up for next week's session, which is this one with Alvin at Dr. Wealth. And also, there's an opportunity for you to schedule a call with one of our MAS licensed representatives. So you click on it and book an appointment. I know there was a lot of questions about Endowus. Please click on that link in YouTube underneath and book a quick call. Our representatives will be very happy to answer those calls. With that, Ser Jing, thank you so much for joining us. Any last words before we sign off tonight?
No last words, but just like to thank everybody for their time in listening, and of course, you, Sam, for this wonderful conversation. I had so much fun. Actually, kind of sad that it's gonna end, but I'll be also tuning in next week. I'm really looking forward to your conversation with Alvin. I met Alvin a couple of times. Great guy. Love the Dr. Wealth, the organization. So yeah, I'm really the conversation that you're gonna have.
Really excited that we have such great speakers. Thank you, Ser Jing, for joining us. The Good Investors blog is a great place for people to learn about investing. And I don't think I'm allowed to do a plug for Compounder Fund, so I won't do it. But everybody heard me say that, so so hope they get the message in between the lines. Thank you, Ser Jing, so much for joining us. It was great fun, and we'll catch up again offline as well, especially when circuit breaker lifts. Really looking forward to Friday.
Thank you. Yeah, I really look forward to meeting you guys.
Yeah, sounds good. All right. Thank you. Take care. Thank you, everybody, for joining us. Have a wonderful evening. And please join us for our session next week as well. Thank you.